Palantir Technologies is preparing to share its financial results for Q3, and this event is scheduled to take place on November 3rd after the market closes. This announcement is drawing significant attention from both investors and analysts who are eager to see how the company continues to perform amid the growing demand for artificial intelligence solutions across industries. Palantir has been one of the most closely watched technology companies this year because of its steady involvement in government contracts and expanding commercial operations. According to the Zacks consensus estimate, Palantir is expected to report earnings of 17 cents per share for the quarter that is about to be released. This figure represents an impressive 70% increase compared to the same period 1 year earlier, which highlights the company's ability to grow profitability despite a highly competitive technology environment. Meanwhile, total revenue is estimated to reach approximately $1.1 billion, which would represent an outstanding 50.7% growth on a year-over-year basis. Analysts have not made any changes to their forecasts recently, suggesting that expectations for Palantir's performance have remained stable. It is also important to recognize that Palantir has built a reputation for outperforming estimates in the past. The company has managed to surpass the Zacks consensus estimate in 3 of the previous 4 quarters, while in 1 quarter it matched the expected numbers exactly. Across these 4 quarters, Palantir achieved an average earnings surprise of about 13.2%, which demonstrates that the company consistently delivers stronger results than analysts anticipate. However, the predictive model from Zacks does not currently indicate a strong likelihood of another earnings beat this time around. Normally, a company is more likely to exceed earnings expectations when it has both a positive earnings expected surprise prediction and a favorable Zacks rank. Typically, ranks of 1 for strong buy, 2 for buy, or 3 for hold suggest that an earnings beat might occur. Unfortunately, this is not the case for Palantir at this time. The company currently has an earnings expected surprise prediction of negative 5.88% along with a Zacks rank of 3, which classifies it as a hold. This combination does not strongly indicate an upcoming earnings surprise. Even with that, investors remain optimistic about Palantir's future because its revenue growth appears to be on a solid upward path. The company's top line is expected to improve significantly on a year-over-year basis, supported by robust demand from both existing and newly acquired clients. Both the government and commercial divisions of Palantir are expected to show meaningful growth as the company continues to expand its customer base and deepen its relationships with long-term clients. The consensus estimate for the government segment stands at approximately $602.5 million, which would represent a 47.6% increase from the same period a year earlier. This growth likely reflects the growing number of government agencies that rely on Palantir's advanced data analytics and artificial intelligence platforms to enhance decision-making and operational efficiency. Meanwhile, the commercial division is expected to generate around $493.7 million in revenue, which represents a 55.6% year-over-year increase. This shows that Palantir's technology is not just valuable for defense or public sector clients, but is also gaining traction with private enterprises that are looking to harness the power of artificial intelligence and data processing to improve business outcomes. When we take a broader view of Palantir's performance, it becomes clear that the company has experienced a remarkable rise in its stock price throughout the year. Shares of Palantir have increased by roughly 151% year to date, which is a massive gain compared to the 22% growth seen across its broader industry. This outstanding performance has reinforced Palantir's reputation as one of the leading artificial intelligence-focused technology companies in the market. Many investors have become increasingly interested in this stock as they search for ways to benefit from the global shift toward artificial intelligence innovation. However, while Palantir's growth story remains compelling, it is equally important to evaluate the stock's current valuation carefully. Based on its trailing 12-month enterprise value to earnings before interest, taxes, depreciation, and amortization ratio, Palantir shares are currently trading at about 1,122 times, which is far above the industry average of 15.27 times. This figure indicates that investors are paying a very high price relative to the company's underlying earnings potential. Similarly, when we look at the forward 12-month price-to-earnings ratio, Palantir stock is valued at roughly 229.14 times forward earnings, which is also much higher than the industry average of 38.98 times. Such high valuation multiples suggest that the market has already priced in a large portion of Palantir's future growth expectations. While strong earnings and revenue growth can sometimes justify premium valuations, investors must be cautious when the price moves too far ahead of the company's actual performance. Essentially, Palantir's current valuation leaves limited limited room for near-term upside, meaning that new investors might face challenges finding attractive entry points at current price levels. Palantir's overall growth momentum remains impressive, supported by solid demand in both its government and commercial businesses. The company continues to make progress in improving profitability, which reflects its ability to manage costs and enhance margins. Additionally, Palantir's continued innovation in artificial intelligence and big data analytics positions it well for long-term success. Yet, the near-term valuation risks cannot be ignored, and for that reason, a more cautious approach might be appropriate. Given the combination of strong operational fundamentals but an elevated valuation, adopting a hold position ahead of the upcoming Q3 earnings release appears to be the most reasonable approach. Investors who already own shares might consider maintaining their positions while keeping an eye on future contract announcements and profit margin trends. Those who are looking to enter may find better opportunities if the stock experiences a temporary decline following the earnings release. As Palantir's valuation continues to rise, it can be helpful to compare the company with other defense and technology-focused firms that offer exposure to similar markets, but at more reasonable valuations. For example, Lockheed Martin remains a solid choice for investors seeking steady performance and less price volatility. Lockheed Martin has a long history of securing large defense contracts that provide consistent cash flow. Its forward 12-month price-to-earnings ratio is below 18 times, and its trailing 12-month enterprise value to earnings before interest, taxes, depreciation, and amortization ratio is under 13 times. This means the company's stock is priced much more conservatively than Palantir's, while still benefiting from a strong global defense demand environment. Lockheed Martin's position is further strengthened by the global trend toward rearmament and increased defense spending, which ensures stable earnings and cash flow in the years ahead. Because of this, the company is often seen as a reliable option for investors who prefer stability and lower volatility over the rapid price swings that are common in technology-focused stocks like Palantir. Similarly, RTX Corporation stands out for its advanced missile systems and solid defense backlog, both of which underline the company's financial resilience. RTX's forward 12-month price-to-earnings ratio is below 28 times, while its trailing 12-month enterprise value to earnings before interest, taxes, depreciation, and amortization ratio is just below 19 times. These figures highlight that RTX offers a balanced combination of growth and value. Although it does not have the same level of excitement surrounding artificial intelligence as Palantir, it provides more consistent performance and less valuation risk for conservative investors. In summary, Palantir Technologies continues to demonstrate strong growth across both its government and commercial operations. Its revenue expansion and consistent profitability improvements showcase a well-executed business model that benefits from the rising demand for artificial intelligence and data-driven solutions. Nevertheless, its current stock price reflects extremely high expectations, which limits the potential for significant short-term gains. Investors should approach this stock with patience and consider balancing their portfolios with more moderately valued defense companies like Lockheed Martin and RTX Corporation. These alternatives can provide more predictable returns while still offering exposure to sectors that benefit from technological advancements and defense-related spending. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.